Imagine this. The trend is strong. You've been waiting for a discount. Finally, the price drops. You tell yourself, this is it. You buy the dip, and then the floor falls out. You didn't buy the bottom, you caught a falling knife. Panic sets in, you sell to stop the pain. And the moment you sell, the market reverses without you. Does that feel personal? It should. But here is the uncomfortable truth. That wasn't bad luck. And the market isn't rigged against you specifically. That move was engineered. While you were panic selling, someone else was calmly buying everything you had to offer. Welcome to the deep dive into the psychology of pullbacks. Today, we are not just learning technical analysis. We are dissecting the core of market mechanics. I'm going to show you how to stop being the liquidity for big banks and how to start trading with them during their most critical phase. Institutional reaccumulation. Most traders miss the turn because they are trapped in a fundamental disconnect. When a trend corrects, retail traders shift from FOMO, the fear of missing out, to a primal fear of loss. As price drops, those who bought at the peak begin to panic. They see their hard-earned gains evaporating. Meanwhile, those waiting on the sidelines jump in too early. This is the pullback paradox. Think about the physics of a market move. For a large institution to buy $10 million worth of an asset, they need someone to sell them $10 million worth. If the market is bullish and everyone is holding, there is no liquidity. The institution cannot fill their order without driving the price up against themselves. So, what do? They wait for the pullback. They wait for the moment when the average trader's conviction breaks. Smart money operates on a different clock. They don't chase, they absorb. They understand that to fill massive orders, they need a selling climax. They need you to be afraid enough to sell your shares or your contracts at a discount. Your panic is their liquidity. This is a transfer of ownership from weak hands, those trading on emotion and low capital, to strong hands, those trading on logic and massive reserves. If you cannot spot where the pain point is for the average trader, you are likely the one providing the exit for someone else's entry. In this first 10 minutes, I want you to burn this into your mind. Price does not move because of charts. It moves because of the interaction between those who are forced to sell and those who are positioned to buy. To trade like an institution, you must stop looking at what price is doing and start looking at how it is doing it. We look for the footprint. The first and most vital sign is absorption. Think of a high-speed car hitting a massive sandbank. The car is moving fast, but the moment it hits the sand, its momentum vanishes. The wheels are still spinning, the engine is roaring, but the car isn't moving forward. In the markets, this looks like a large, aggressive red candle followed by high volume, but very little downward progress. Look at the volume bars. They are exploding. Now look at the price candles. They are getting smaller. They are wicking. If there was truly so much selling volume, why didn't the price continue to crash? It's because a massive wall of passive buy limit orders, institutional orders, absorbed every single market sell order. The sellers are exhausted and the buyers are just getting started. The second footprint is the structural shift. Institutions cannot hide their size forever. As they build their positions, they create what we call a rounded bottom or a higher low sequence. They aren't waiting for the absolute bottom anymore because they've already secured the bulk of their position. They start stepping up their bids. When you see a price attempt to revisit the lows and it fails to get there, even by a small margin, that is the market telling you that the supply has been soaked up. The smart money is now protecting the floor. They have a vested interest in keeping the price above their accumulation zone. Finally, we must respect the element of time. Retail traders want a V bottom because it provides instant gratification. We want to be right now. Institutional reaccumulation is a process, not an event. It can take days, weeks, or even months of sideways grinding to fill their orders. Why? Because if they bought everything at once, the price would spike, and they'd get a bad average entry. They buy a little, let the price drift, buy a little more, and let the price drift again. If you see a market that refuses to go lower despite bad news or heavy selling pressure, you are looking at a master at work. Now, let's go deeper into the psychology of the trader. Why is this so hard to execute? It's because your brain is wired to avoid pain. Evolutionarily, when you see a crash, your amygdala triggers a flight response. In the wild, running away from a falling tree is smart. In the markets, running away from a falling price is often how you miss the greatest opportunities of your life. To succeed, you must train yourself to lean into the discomfort. The first major trap is the early entry bias. You want the trend to continue so badly that you interpret every minor bounce as the start of the next leg up. You see one green candle and you market buy. But the institution isn't done accumulating. They let the price drop one more time to shake you out. It fails. You buy again, it fails again. By the time the actual institutional reaccumulation occurs, you are emotionally exhausted. You've taken 3 losses, your account is down, and when the real signal appears, you're too paralyzed to click the button. The second trap is confirmation bias. You seek out influencers or news articles that tell you the dip is over while ignoring the raw price action telling you the selling hasn't finished. You are looking for a reason to be right rather than looking for a reason to trade. To overcome this, you must achieve a state of detachment. You aren't buying a dip, you are identifying a shift in control. Stop watching your unrealized P&L. Start watching the behavior of the candles. Use price alerts. If you stare at a falling chart for 5 hours, your brain will eventually hallucinate a reversal signal just to make the anxiety stop. Walk away. Let the price hit your predefined zone. Let the market prove it is ready to move before you put your capital at risk. Precision is where we separate the amateurs from the professionals. We don't just buy somewhere near the bottom. We look for confluence, the meeting of multiple independent signals. We start with the volume profile. We look for the high volume nodes, the price levels where the most business was transacted during the previous uptrend. When price returns to these levels, it isn't hitting random support. It is hitting a level where institutions have a memory. They defend these levels because their previous average entry price is often located there. If you see price hit a high volume node and the volume starts to spike while price stays flat, you have found your point of control. One of the most powerful precision setups is what we call the spring. This is a deliberate stop run. Imagine a clear support level where everyone has placed their stop losses. The smart money knows those stops are there. They will allow, or even push, the price to briefly pierce that level. To the retail trader, this looks like a breakdown. They sell. The shorts jump in. But then, almost immediately, the price snaps back above that support. That snap back is your signal. It tells you the breakdown was a trap designed to generate the liquidity the institution needed to finish their buy orders. Your entry isn't at the very bottom of the wick. That's gambling. Your entry is the moment price reclaims the level. Before you enter, you must go through a mechanical checklist. Is the higher time frame trend still bullish? Has the price reached a significant value zone or high volume node? Do we see evidence of absorption, high volume with a little price movement? Has a spring or liquidity grab occurred? If you can't check all 4 boxes, you don't have a trade. You have a guess. Let's wrap this up into a step-by-step playbook you can use for the rest of your career. Phase 1. The observation. When the pullback starts, we do nothing. We don't try to be heroes. We simply mark our levels. Phase 2. The arrival. Price enters our zone. We look for the footprints we discussed in Module 2. We are looking for that car hitting the sandbank. Phase 3. The shakeout. We wait for the spring. We wait for the moment of maximum pain, where the last retail traders give up. Phase 4. The confirmation. We look for a break of the local market structure, a higher high on a 5-minute or 15-minute chart. Risk management is your armor. In a pullback environment, Volatility is your enemy until it becomes your friend. Because we are entering at the source of the potential new move, our risk is incredibly tight. Your stop loss doesn't go in a random place. It goes below the spring low. If price returns to that level, the institutional defense has failed and your thesis is wrong. Get out. Because our stops are tight, our risk-to-reward ratios are massive. You can be wrong 50% of the time and still be incredibly profitable because your wins, capturing the next leg of a major trend, are 5 or 6 times larger than your losses. Stop fearing the pullback. In a healthy market, a pullback is not a sign of weakness. It is the market refueling for the next journey higher. It is a necessary mechanical process that allows big players to get on board. If you can master the psychology of the dip, you stop being a victim of the market and you start becoming a partner to the institutions. You move when they move. You sit when they sit. Trading is not about being the smartest person in the room. It's about being the most patient. Study the footprint. Wait for the trap. Execute with cold, mechanical discipline. Thank you for spending this time with me. Go back to your charts, find these reaccumulation phases, and start seeing the market for what it truly is: a battleground of psychology and liquidity. I'll see you in the next session.